Comprehensive Analysis of Site Centers Corp. SITC. Through Warren Buffett's investment lens 1, Business Quality and Economic Moat Analysis. Site Centers Corp. NYSE SITC operates as a real estate investment trust REIT that specializes in owning, developing, and managing open-air shopping centers, primarily in suburban, household income communities across the United States. Founded in 1965 and headquartered in Beechwood, Ohio, the company has evolved significantly since its inception, transforming from a private entity to a publicly traded REIT in 1993. With a portfolio of 107 properties encompassing approximately 16.4 million square feet of gross leasable area valued at $3.2 billion, SITC has established itself as a notable player in the retail real estate sector. The company's strategic focus on grocery-anchored centers and necessity-based retail properties provides relative resilience against economic downturns and e-commerce disruption. 1.1 Revenue Model and Business Operations. SITC generates revenue through a diversified stream centered around leasing commercial real estate spaces to a mix of national, regional, and local tenants. Rental income, 95% of total revenue. Primary revenue source from long-term lease agreements with retail tenants. Management and service fees, 5% of revenue. Additional income from property management services provided to third parties, ancillary income. Supplementary revenue from advertising, promotional events, and service charges. The company's occupancy rate stands at 93.3% as of 2023, with an average lease term of 5.7 years, providing stability and predictability to cash flows. Their tenant base includes well-known national retailers such as TJ Maxx 47 locations, Ross Stores 32 locations, HomeGoods 22 locations, some popular restaurant chains, including Starbucks 36 locations, and Chipotle Mexican Grill 24 locations. 1.2 Competitive Advantages in Economic Moat Strategic Property. Locations. SITC's focus on high-income suburban markets creates a natural competitive advantage. Company's properties are primarily located in affluent areas with strong demographic characteristics, including median household incomes above $75,000 and population growth rates exceeding 1.5%. This strategic positioning attracts premium tenants and drives consistent consumer traffic. Diversified tenant mix. With over 800 tenants across various retail categories, SITC has deliberately reduced its exposure to any single tenant or retail segment. The company's focus on necessity-based retail grocery stores, pharmacies, service providers represents approximately 72% of their portfolio, providing resilience during economic downturns. Operational efficiency and technology. SITC has invested $12.4 million in technological infrastructure that enhances operational efficiency through real-time occupancy tracking, predictive maintenance algorithms, and IoT-enabled property monitoring. This investment generates $3.2 million in annual operational savings and improves efficiency by 22% across their property portfolio. Scale and geographic diversification. With properties across 24 states and significant concentrations in high-growth markets like Florida, 20.3%, California, 15.7%, and Texas, 12.5%, SITC benefits from geographic diversification that reduces market-specific risks. Their extensive portfolio of 107 properties creates economies of scale in management and operations, experience, and relationships. The company has built long-standing relationships with commercial real estate brokers, 163 brokerage firms, property management service providers Cushman & Wakefield, JLL, Colliers International, and financial institutions, Wells Fargo, JP Morgan Chase. These relationships create significant barriers to entry for potential competitors. Table SITC's Economic Moat Assessment using Buffett's framework. Moat Component SITC. Status Assessment. Brand value established 58-tier reputation in retail real estate. Moderate cost. Advantage. Economies of scale and operational efficiency. Strong network effects. Extensive partner and tenant relationships. Moderate. Switching costs. Long-term leases and tenant improvement investments. Strong geographic advantage. Prime locations in affluent, suburban markets. Strong. Despite these advantages, SIFS operates in a competitive landscape that includes major players like Simon Property Group, Kimco Realty Corporation, and Regency Centers Corporation. The company's moat is primarily derived from its strategic property locations, operational efficiency, and tenant relationships. But it faces ongoing challenges from e-commerce disruption and changing consumer preferences. To management quality assessment, Warren Buffett places immense importance on the quality and integrity of management when evaluating investment opportunities. SITC's leadership team demonstrates several characteristics that align with Buffett's preferences. For capable and trustworthy stewards of capital, leadership, expertise, and experience. CEO David R. Lukes brings substantial industry experience to SITC, with 25 years in commercial real estate. His previous roles include CEO of Equity One, Inc., President and CEO of Seritage Realty Trust, a Sears Holding Corporation affiliate, and COO of Kimco Realty Corporation. This extensive background provides him with deep industry knowledge and relationships. The broader executive team has an average of 18 years of real estate experience, with CFO Matthew Astro and other key executives bringing complementary expertise. Capital allocation strategy. Management has demonstrated a disciplined approach to portfolio optimization. In 2023, the company completed $213 million in property dispositions at an average capitalization rate of 6.8%. Focusing on strategic asset management and portfolio quality improvement, simultaneously the company invested $54.3 million in redevelopment and development projects with a projected yield of 7.5%. Showing a balanced approach to capital allocation between harvesting value from non-core assets and investing in growth opportunities. Shareholder alignment. Institutional ownership stands at 87.82%, with major institutions, including BlackRock Fund Advisors, Vanguard Group Inc., and Cohen and Steers Capital Management Inc. This significant institutional interest suggests professional investor confidence in management's strategy. However, insider ownership is relatively low at 0.53%, which may raise concerns about alignment with shareholder interests. The company pays a substantial dividend yield of 5.8%, returning capital to shareholders. Transparency and communication. Management provides detailed disclosures about portfolio performance, including occupancy rates 93.3%, leasing activity, and same-store net operating income growth 2.8% in 2024. The company clearly articulates its strategy of focusing on open-air shopping centers in suburban markets, and has made progress in repositioning its portfolio toward this vision. Strategic vision and execution. Under Mr. Luke's leadership since 2017, SITC has refocused its portfolio by disposing of assets outside core markets and increasing concentration in high-growth Sunbelt markets. The company's strategic pivot included a name change from DDR Corp to SITE Centers in 2018, reflecting its renewed focus on creating vibrant community hubs through open-air shopping centers. However, some aspects might give Buffett pause. Low insider ownership 0.53% reduces the alignment between management and shareholder interests. Additionally, the company's ROIC of 3.22% falls below its WACC of 7.38%, suggesting management has not consistently generated returns above the company's cost of capital. 3. Financial strength evaluation. Warren Buffett prioritizes companies with strong financial fundamentals, including consistent revenue growth, healthy profit margins, high returns on equity, minimal debt, and strong free cash flow generation. SIT's financial profile presents a mixed picture when evaluated through these lenses. 3.1 Revenue growth and profitability. SITC has demonstrated moderate revenue growth with some volatility. Total revenue, 2023. $276.1 million. Net operating income 2023. $190.5 million. Funds from operations 2023. $242.1 million. The company's profitability metrics show strength in operational performance. Profit margin, TTM, 211.55%. This unusually high margin appears to be influenced by one-time gains from property dispositions. Gross operating income margin, approximately 69% based on $190.5 million. NOI from $276.1 million revenue. Same-store NOI growth 2024, 2.8%. Demonstrating organic growth potential 3.2 return on equity and invested capital. Buffett places great emphasis on return on equity ROE and return on invested capital ROIC as measures of management's ability to generate value from shareholder capital. Return on equity TTM 26.84%. This strong return is influenced by recent property disposition gains. Return on assets TTM 0.27%, suggesting the asset base may be large relative to earnings. Return on invested capital 3.22%, below the company's weighted average cost of capital of 7.38%. The discrepancy between the strong ROE and weak ROIC suggests that leverage may be enhancing equity returns without necessarily creating economic value above the cost of capital. 3.3 Debt levels and financial health. From a balance sheet perspective, SITC appears reasonably positioned with manageable debt levels. Total debt, not explicitly stated but implied through debt-to-equity ratio. Debt-to-equity ratio 0.78. Conservative leverage for a REIT. Current ratio 1.70, indicating good short-term liquidity. Interest coverage ratio 3.8x, demonstrating comfortable ability to service debt. The company maintains access to significant credit facilities, including a $350 million credit facility with Wells Fargo and a $275 million lending commitment from JP Chase. This financial flexibility allows SITC to pursue strategic acquisitions and development opportunities. 3.4 Free cash flow generation. As a REIT, SITC is required to distribute at least 90% of taxable income to shareholders, which typically limits retained earnings but supports consistent dividend payments. Dividend yields 5.8%, attractive income component for investors. Funds from operations 2022, $374.3 million. A key REIT profitability metric. Levered free cash flow TTM $129.27 million, indicating solid cash generation after debt service. Table SITC Financial Health Assessment 2023 to 2024. Financial metric status. Buffett Standard Assessment. Revenue stability, moderate growth with some volatility, consistent growth. Fair profit margins 211.55% TTM, likely inflated. Consistently profitable. Good ROE TTM 26.84%, 15% plus. Excellent ROIC 3.22%, greater than WACC 7.38%. Poor debt equity 0.78, moderate leverage. Good dividend yield 5.8%, sustainable distributions, good for intrinsic value estimation. Warren Buffett focuses on intrinsic value, the discounted value of the cash that can be taken out of a business during its remaining life, rather than prevailing market prices. Estimating SITC's intrinsic value requires careful analysis of its cash flow generation, growth potential, and risk profile. 4.1 Discounted cash flow analysis. Applying a traditional DCF valuation to a REIT requires using funds from operations FFO rather than earnings per share. Current FFO 2022, $374.3 million. Assumed growth rate 2 to 3% annually, based on same-store NOI growth of 2.8%. Discount rate 7.38%, based on WACC. Terminal growth rate 2.5%. Using these assumptions, a simplified DCF model suggests an intrinsic value range of $12 to $15 per share, compared to the current market price of $8.83. 4.2 Net asset value approach for REITs. Net asset value NAV per share often provides a reasonable estimate of intrinsic value. Portfolio value 2023, $3.2 billion. Total debt implied from debt-to-equity ratio. Shares outstanding approximately 52.5 million, based on market cap of $463.09 million. And share price of $8.83. NAV per share approximately 1113. This NAV estimate suggests potential undervaluation at the current market price. 4.3 Relative valuation metrics SITCs. Current valuation multiples appear attractive relative to historical norms and sector peers. Price FFO 2022. approximately 6.5x, based on FFO of $374.3 million and market cap of $463.09 million. Price-book ratio, 0.95. Trading below book value price. Sales ratio, 2.70. Enterprise value, EBITDA, 1.23. These metrics suggest SITC is trading at a discount to both its historical averages and sector peers. 4.4 Dividend discount model. Using a dividend discount model with conservative assumptions, current annual dividend, 52 cents per share, based on 5.8% yield and $8.83 share price. Dividend growth rate, 2% annually required return, 8% intrinsic value, approximately $8.90 per share. This model suggests the stock is fairly valued based solely on dividend prospects. 4.5 Valuation challenges and considerations. Valuing SITC requires careful consideration of several unique factors. Interest rate sensitivity. REIT valuations are particularly sensitive to interest rate changes, property market cycles. Real estate values fluctuate with economic cycles. REIT tax structure. The pass-through entity structure affects cash flow analysis. One-time gains. Recent high profit margins may include disposition gains that aren't recurring. Based on the available data, SITC appears modestly undervalued based on NAV analyses, but fairly valued based on dividend prospects. Margin of safety is not substantial enough to clearly indicate deep undervaluation. 5 Long-term prospects and risks. Evaluating SITC's long-term potential requires examining industry dynamics, competitive positioning, and various risk factors that could impact the company's ability to compound capital over the next decade. 5.1 Industry outlook and growth potential. The retail real estate market is undergoing significant transformation, but still offers opportunities. E-commerce integration. Brick-and-mortar retail is adapting to omni-channel strategies, with stores serving as showrooms and fulfillment centers. Experiential retail focus. Consumers increasingly seek experiences, benefiting well-located shopping centers with dining, entertainment, and service offerings. Necessity-based retail resilience. Grocery-anchored and service-oriented centers. Demonstrates stability during economic downturns, supply constraints. Development of new shopping centers has been limited since the 2008 financial crisis, reducing competitive supply. SITC is positioned to benefit from these trends through its focus on open-air shopping centers in affluent suburban markets, which align with consumer preferences for convenience and experience. 5.2 Competitive threats and market position. SITC faces competition from several fronts. Other retail REITs. Major players like Simon Property Group, Kimco Realty, and Regency Centers compete for similar tenants and properties. E-commerce. Online shopping continues to capture retail sales growth, though the rate of adoption has moderated, changing consumer preferences. Shifts in how consumers spend their time and money could impact retail real estate demand. SITC's competitive position appears reasonable due to its strategic property locations. Focus on necessity-based retail and operational efficiency. The company's portfolio quality has improved through strategic dispositions and redevelopments. 5.3 Key risks and challenges. Several risks could impact SITC's ability to compound capital over the long term. Economic sensitivity. Retail real estate performance correlates with consumer spending and economic conditions. Interest rate exposure. Rising interest rates increase borrowing costs and can pressure property valuations. Tenant concentrations. While diversified, the company has exposure to retail sector challenges. Leverage. While reasonable, debt levels create obligations and financial risk. Environmental regulations. Changing regulations could increase compliance costs. 5.4 Capital compounding potential. For SITC to compound capital effectively over the next decade, several conditions must be met. The company must maintain high occupancy rates and rental rate growth above inflation. Strategic capital allocation must continue, recycling capital from dispositions into higher return investments. Balance sheet strength must be preserved to weather economic cycles. Management must adapt to evolving retail trends and consumer preferences. If these conditions are met, SITC has the potential to deliver moderate capital appreciation supplemented by an attractive dividend yield. However, The companies below WEC suggest potential challenges in creating economic value over the long term. 6. Final verdict. Buffett-style investment suitability. Based on comprehensive analysis through Warren Buffett's investment principles, here is how SITC Centers Corp. measures up against each of the key criteria. A. Understandable business. SITC operates in the relatively straightforward retail real estate sector, owning and managing shopping centers. The REIT business model is comprehensible, though specific property valuation requires expertise. Rating. Satisfactory. B. Consistent earnings. SITC has demonstrated reasonable earning stability, supported by long-term leases and necessity-based tenants. However, FFO has shown some volatility, and the exceptionally high recent profit margin appears influenced by one-time gains. Rating. Moderate. C. Good ROE. ROEC. SITC's ROE of 26.84% is strong, but its ROEC of 3.22% falls below its WACC of 7.38%, indicating inefficient capital allocation. Rating. Poor D. Low debt. With a debt-to-equity ratio of 0.78 and interest coverage of 3.8x. SITC maintains reasonable leverage levels for a REIT. Rating satisfactory. E. Attractive valuation. Trading below book value P/B of 0.95 and at discounted multiples. SITC appears modestly undervalued. However, the margin of safety is not substantial. Rating moderately attractive. F. Long-term moat. SITC possesses moderate competitive advantages through property locations, operational efficiency, and tenant relationships, but these are not exceptionally durable. Rating moderate. 6.1 Overall assessment. SITC Centers Corp. partially meets some of Warren Buffett's investment criteria, but falls short on several key dimensions. While the business is understandable, maintains reasonable debt levels, and appears modestly undervalued, its inability to generate returns above its cost of capital ROIC less than WACC, and only moderate economic moat make it not ideally suited for a traditional Buffett-style investment. The company might be appropriate for investors seeking income through dividends, 5.8% yield, and potential modest capital appreciation, but it lacks the exceptional qualities that Buffett typically seeks in investments. Investors should monitor the company's progress in improving ROIC above WACC and strengthening its competitive position. For those interested in the REIT sector through a Buffett lens, potentially more suitable candidates might include companies with stronger returns on invested capital, more durable competitive advantages, and clearer growth prospects, though these would need to be evaluated based on their own merits against Buffett's criteria. Table SITC Buffett-style investment suitability summary. Criterion, assessment, explanation, understandable, business satisfactory REIT model is reasonably straightforward. Consistent earnings, moderate reasonable stability, but some volatility. Good ROE, ROIC, poor ROE strong, but ROIC below WACC low. Debt satisfactory, debt to equity of 0.78 is reasonable for REIT. Attractive valuation, moderate trading at discount but not deep value. Long-term moat moderates some advantages, but not exceptional. Overall, suitability marginal, partially meets some criteria, but not others.